Hey everyone. Today I want to tackle some persistent myths and misconceptions when it comes to investing that keep everyday folks from building real wealth and achieving financial freedom. There are so many false narratives like active trading works, market timing works, get-rich-quick schemes are realistic and more. I want to dig into each one in detail and clear up the truth when it comes to proven investing principles. This will allow you to avoid falling for myths that sabotage your wealth-building journey. My goal is for you to have clarity on what really works when growing your money consistently over time through investing. Let's get started. Myth 1. You must pick stocks to get good returns. The first major myth is that you need to actively pick individual stocks and constantly trade in and out of them to get high investment returns. In reality, the vast majority of professional active traders fail to beat the market over 10+ year periods after fees are factored in. Passive index funds that track the market reliably outperform stock pickers over the long haul. This is backed up by mountains of statistical data. Rather than picking individual stocks, simply invest in low-cost, diversified index funds that give you exposure to hundreds of stocks across sectors, geographies and market caps. This passive approach works consistently over decades. Myth 2. Market timing strategies work. Another big myth is that market timing strategies can deliver better returns than buy and hold investing. This involves trying to predict market tops and bottoms to get in or out. In reality, consistently timing the exact market highs and lows is essentially impossible, even for experts. There are always folks who claim they saw the crash coming, but these are just chance occurrences. No one can predict short-term market movements with consistent accuracy. Missing just a few of the market's best days means hugely reduced returns compared to buy and hold. Rather than trying to time the peaks and valleys, stay fully invested through ups and downs to capture the market's long-term trajectory. Time in the market beats timing. Myth 3. You can get rich quick with trading. Next myth that speculative trading or trends like day trading allow you to build tremendous wealth quickly. Reality is that sustainable wealth building through trading or any means takes decades of discipline, not days or months. Beware of any get-rich-quick investing promises. While a small percentage may strike it big on one or two lucky trades, these wins are not repeatable or reliable methods to build wealth. Success almost always comes down to luck, not skill. Focus on setting up a passive, diversified portfolio built to deliver average market returns of 8–10% over a lifetime. Get rich slow through proven long-term strategies. Myth 4. Real estate always appreciates. Another common myth is that real estate consistently appreciates strongly over time regardless of market conditions. In reality, housing is cyclical like any other asset class. There are periods of booms and busts, both nationally and locally. Housing prices can stagnate or lose value over 5–10 year periods. Don't assume real estate in a certain area will keep rising forever. Make conservative projections that account for potential housing downturns as part of long-term planning around investment properties. Myth 5. Gold is the only safe haven. Some perpetuate the myth that gold is the one surefire safe haven asset to protect against risks like inflation or geopolitical turmoil. However, gold's status as a universal hedge or safe haven investment is also overstated in many cases. Its price is actually highly volatile and driven by speculation. Owning some gold in a diversified portfolio can make sense, but don't view it as a guarantee against economic crises or as an asset that won't decline during stock market downturns. Diversification across asset classes is key. Myth 6. Individual stocks are less risky than index funds. Some believe owning a basket of individual stocks across sectors is safer than simply owning index funds. The idea is you can pick stable stocks and avoid volatility. In reality, individual stocks carry tremendous single-company risk that index funds eliminate through broad diversification. Even seemingly stable giants can see their stocks plummet on bad news. Owning an index fund gives you exposure to hundreds of stocks and smooths out risks. Idiosyncratic risks of individual companies are diversified away, leaving just market risk you want. Myth 7. You must beat the market to win. Another myth is that you must beat the market substantially to be considered a successful investor. Just matching market returns is seen as mediocre by some. Actually, just matching the market's historical average annual returns of 8–10% over decades will grow your wealth tremendously thanks to compounding. Trying to beat the market leads many investors to take on excess risk, trade too much, and ultimately underperform after fees. You can do extremely well simply by meeting market returns. Myth 8. More trading means more profits. Some assume increased trading frequency equals better returns. Whether day trading or swing trading, the notion is more trades equals more money. In fact, excessive trading creates unnecessary fees, taxes, and bid-ask spread costs that eat into returns. Not to mention the mistakes caused by overtrading. Trading less frequently and minimizing costs is a far better path to wealth building for most investors. Set up a diversified portfolio and let it compound over decades with minimal trades. There are so many other investment myths we could debunk, like you can beat index funds or bonds are always safe. The bottom line: avoid falling for narratives that have little factual evidence or historical precedent. Stick to proven investing principles backed by decades of data, like diversifying across index funds, staying invested through ups and downs, and letting compounding work over long timelines. I hope this video helped provide clarity against some stubborn investing myths that can detour everyday folks from building wealth. Please subscribe for more content soon.